Hey, I'm Abe, and today we're going to talk about down payments when planning to buy a house. It's good to understand everything that's involved there before we continue on in our discussion about whether you should buy or whether you should continue to rent. Mortgages generally require you to have a down payment or that you provide some sort of collateral, some form of money on your own to go along with the loan that the bank is providing for you. Now, there are a few options. Generally speaking, you can put in anywhere from 0 to 100% down, which means you can give nothing of your own and then end up with a mortgage for everything, or you can use entirely cash to buy a house. And at that point, you don't have a mortgage, and it's probably a very different conversation. But there are some tiers to be aware of. I don't know how readily available getting a mortgage for anything really is if you're not putting anything of your own down. So let's look at a minimum of 3.5% down. And when we use percents like this, we're referring to the percentage of the home value. In our case, it's an $100,000 house. We're just using that for easy math. But if you put 3.5% down, you're likely going to get or need to work with an FHA loan, which is a Federal Housing Administration loan. And with this, because the down payment is so small, the standard generally is about 20% down. But if you go as low as 3.5%, then there are a couple things that need to kick in to allow you to continue to have this mortgage. The first is upfront mortgage insurance, and there's a premium associated with that of 1.75% of the loan amount. And annually, so every year, you'll need to pay a mortgage insurance premium of 0.85% of the remaining loan amount. Now, mortgage insurance is something that you end up having to pay for to act as a safety net for the bank. The bank is saying you did not give as much money as we think is a safe amount, and as a result, you need to carry this insurance so that if you default on your mortgage, the insurance company will pay us and we won't lose that money. So that's what mortgage insurance is, and in this case it is a sort of a government mortgage insurance as opposed to a private mortgage insurance. So for our $100,000 house, you're looking at $3,500 then for your down payment. And you might be thinking, great, I can come up with $3,500. That's not bad compared to what I'm sort of putting together to rent an apartment. But that upfront mortgage insurance premium that we talked about of 1.75% adds another $1,750 on top of that. Plus, and annually, you'll have to pay a premium of 0.85% of the remaining loan amount. Now, if you only put $3,500 down, the remaining loan amount is $97.5, so that'll be just somewhere in the vicinity of about $800 that they'll spread out over the year. And so every month of that year, you will have a 1/12 of that added on to your mortgage. What this means is that if you can only save up 3.5% of your down payment, you essentially actually need to end up paying 5.25% just to cover the mortgage insurance that you're going to need to pick up along with that. Additionally, you've made your mortgage payments through at least the first portion of your mortgage that much more expensive because of the premium that you need to carry throughout. And that premium will continue until you've paid down your loan to the point where you actually have paid in $20,000 or 20% of this amount, and the loan amount is about 80% or $80,000. So once you've reached that, then that insurance can go away and you can continue to pay at the original mortgage rate. Now, if you put down less than 20%, but more than 3.5%, and there may be a cutoff, I couldn't find it easily on the web, but you'll have to pay private mortgage insurance, and that looks like something around 0.5 to 1.0% of the loan amount, and that's a premium that you pay each year divided up or amortized over the 12 months like we talked about. If you put down 10% on your $100,000 house, that means you pulled up $10,000, and your loan amount remaining then would be $90,000, and you'll owe an additional $450 to $900 a year in addition to your mortgage payments until you've paid that loan down, until the loan itself is back down to $80,000. Again, bringing you to that 20% sweet spot. 20% is the standard. So if you put 20% down on your mortgage, then you don't need to carry any kind of insurance. The bank will manage the rest of it on its own, and you are considered sort of a safe bet because you have been willing and able to put forward money of your own that covers a portion of that sale. And then depending on the bank, sometimes a required minimum of 30% is necessary if the mortgage is a large enough mortgage. So in California, sometimes if your mortgage is going to be, like, the loan amount is going to be $2.5 million or greater, it's considered a jumbo loan, at least in the local area, and you're going to need 30% down instead of 20. And that sounds like a lot of money, and it is. And that's the main real hurdle that people have when trying to save up and buy their first house, is this coming up with, the 20% down payment is really a significant step to make. So if you have a $500,000 house, which around here is sort of at the bottom of the market, you can imagine it's very difficult to save up $100,000 that you can then immediately just turn around and dump into a piece of property. And that's at $500,000. If you're at $1 million, now you're looking at $200,000 that you need to save up. $2 million, and so on. So it adds up quickly. And while all of this sounds complicated, the down payment is really just you putting money to say, yes, you can trust me. I'm investing a portion of my own holdings as well, and you can just loan me the rest and I'll pay it off over time. Now, the complexities of what kinds of mortgages to look at we'll get into on Friday. But for now, this is just a quick look at down payments and some of the things that you may need to think about, specifically mortgage insurance, either to the FHA or just a private mortgage insurance. Hit the subscribe button if you've learned something, or if you'd like to learn something else and you want to let me know in the comments, by all means do that. Ring that notification bell. I only post videos 3 days a week because I have too much going on. I can't post any more frequently than that. So, not too many notifications coming your way, but thank you for being here, and I will see you in the next video.